Guys, welcome to this video. As always, don't forget to like, share, comment and subscribe. Get my free training underneath if you're interested in taking trading seriously and making a big change. So in this video, we're going to go over the pound dollar, the pound CAD, the pound AUD. We're really going to centralise around those pound pairs because at the moment what you've got in the UK as of just yesterday is inflation remaining quite still. So I'm going to make this a forecast for 2023 going into 2024. So hopefully if you're watching this back in a little while, that is exactly what you see, and it makes really, really good sense to you at the time. So I'm just going to start things off. This is the Bank of England .co.uk website regarding monetary policy and the interest rate. Now, the reason why I'm doing this is because it gives you an idea of the bank rate over time. Now, the bank rate obviously rules what happens to the GBP, the Great British Pound, because obviously when the bank rates are high, people start to save the money because they know they're going to get a higher interest on it. And conversely, when it's the opposite way, people tend to pull their money out because they're not going to get a good return on investment there. Well, this affects Forex markets in many different ways because obviously if you're comparing the pound against the dollar or the pound against the CAD, the pound against the AUD, they've all got different central bank rates. Okay, so there's a lot of inference you can make both fundamentally and also from a technical basis or a technical bias. In other words, looking at charts, looking at trends, candlesticks, price action, all those things which I teach people in my academy all around the world now, and those things that I employ within my trading. So we're going to go over that. We're going to go over a bit of risk management as well if you're looking to maintain these entries for a longer period of time. If you're an investor or swing trader, it's probably more for you. We'll also look at the near-term markets as well. So it's going to be a full analysis from the beginning all the way to a year in the future or so. So if you just look at the central bank rate here, what you can see is that we were at 6% at the turn of the millennium. This is just after I was born. Okay, I'm 24 now, and what happens is you start to get the bank rate down and it goes flat, and then suddenly it doesn't look so good as an idea of bringing it down, and it starts to come up and up and up, and then it peaks just about the time we get to the financial crisis. Now, when we get to the financial crisis, the central bank, the Bank of England, for the UK, drops straight down. Okay, it drops the rates because they say, you know what, we need to get rates lower so it's cheaper to borrow, because there was a big housing crisis in the US and it just shockwaved everywhere. And that's why you saw so many pairs, so many FX pairs fall accordingly. We're going to reflect that on these pound charts as well, but that was really significant because it set the stage for the trajectory of the market after that, how it recovered, and how it continued to fall. So after that really steep drop, it became absolutely no surprise that 2009 all the way to 2016 was rates that didn't change. Okay, it stuck at 0.5%, so it was really cheap to borrow. You wouldn't get as good return on your savings, but it was considerably cheaper to borrow for a considerable amount of time. And then finally, they even put the rates down to 0.25%. Now, because the rates were low for such a long period of time, it then causes this big anomaly. I mean, you had a lot of borrowing costs, you had COVID, the Ukraine war, and all of it added up and up and up and up. Okay, so what you've got now is high inflation. It's persistent inflation. It didn't drop yesterday. It's about 6.7% was the CPI reading. And that's causing a lot of problems to the Bank of England because they're probably now thinking, you know what, perhaps we need to keep this really fast interest rate increase trajectory continuing. Okay, so it's really interesting just to look at the fundamental aspect of the pound against the US dollar and just understand how bank rates affect currency pairs, because every single jurisdiction, every single economy or global economic zones have central bank rates that rule them in a different way. They've all got different levels of monetary policy, and that does feed into trading a lot. But also, you need to consider the technical side greatly too. So I'm now on TradingView, where I'm a top streamer, top poster, as many of you will know. And I'm going to go over more of the technical side of these GBP pairs. So to do that, I'm going to go on my monthly, and what you can see is exactly what I was saying. Okay, pound dropped significantly against the US dollar, within that time period, bank rates start to fall. You can see there's an immediate decline, comes straight down. Okay, people pull their money out of the pound, they put it into the US dollar. Some people would say that was because it felt safer at the time, but that was a mammoth fall, and it was something everyone remembers. I mean, I was only a kid at the time, but if you're probably older than 30, you remember it very well. People often talk about the suffering that came. There was a lot of it, unfortunately, because economic hardship was rife. People were losing their houses, they were losing their businesses. It was all going wrong. So to stimulate the economy in the UK, they've got to put the rates down because it needs to be cheaper to borrow for people to buy things or start businesses or enjoy themselves in any capacity. So what you had after that simply was a bounce to the upside. So you returned to levels that you were at when you had crashes at the millennium, okay? And you've got pretty much a market maker stop here. You probably had a lot of institutional traders saying, you know what, this is going to be a really ideal level for price. We come right back to where we were at the turn of the millennium, okay, in the year 2001. And that's going to be a good place to get long. And often the orders of institutional traders are so big, they need to get the absolute best price, which of course they did because it was a 100% retracement on the previous move. So the move that went from 2001 all the way to 2007 gets a 100% retracement in a couple of years. So that became the best and ultimate price for institutions and professionals alike to get long. After you had that, okay, you get a considerable bounce all the way up, and it goes straight in line with this level here. Okay, so again, you probably had the larger money in the market shorting at that point, and then you just get your up-down trajectory, your oscillation, and so on. But pretty much since that point, you've just come down and down and down and down. So you had a brief uptrend, 2019 to 14. You start to get Brexit into the mix, as many of you know, and the negative sentiment persists. Okay, and the pound goes down and down and down like this. So we're at a really low point with the pound. If you look at it in that regard, over that period of time, you had the 2008 fall, like this, a little pop up and then big drop. Some people made a lot of money on the short side, some people lost a lot of it. But nonetheless, the point of what I'm saying is you've come down considerably, and it's absolutely no surprise that when you find yourself bouncing at this point, it comes in line with this, just like you had here. And that's why I bang on, that's why I talk about price action so much, because it makes markets very predictable, especially on your highest time frames, because your highest time frames rule the market trajectory. Okay, they rule the long-term market. They really tell you where you're going to go over the very long period of time. So you can see that, okay, you were almost at parity, just about. Price is away. That was too much for a lot of traders. So coming down that far, you had a really good long entry because you were at levels that you hadn't seen since 1985. Naturally, as a trader, you should be saying to yourself, okay, well, if we haven't been this low since 1985, is it possibly the best price I could ever get? Okay, if you look at the TradingView data to 1971, it's way higher at that point. Okay, so it's really important to understand that. But I guess the main point with the pound against the US dollar is the fact that we have now got to a point where your long-term downtrend is continuing. Okay, that's why you've got long-term lower highs, you've got long-term lower lows, and it's still losing value against the US dollar. Okay, so what would you look for really in the future? Well, as you can see, you've lost value for a considerable amount of time now, but within that, you do get considerable pops to the upside. So I would think because you've come down so far, there's still room to the upside. I don't think we're completely done moving up before you go down, if you go down further. So it's a really important idea to reflect on price action there, and price action there. And I suspect that's what's causing markets to stumble a little bit. Now, the reason why I'm on the monthly time frame is because it's going to give you a long-term market trajectory or assumption. If I draw a fib from up here, you can see we're at 0.382 as a retracement on the previous up move. Now, that's not considerably far, And I would much prefer it if we can get further down 0.5, 0.618, because it's going to give us a better entry for those long trades. We're not as low as we were, 1.03, but the market is not as extreme as it was. Okay, so it's really important to note that. So what I would do in that case is I would drop to the weekly, and as many of you know, if you've been watching my posts, my streams, my videos, especially on TradingView, you'll know simply that this candle I spoke about is pulling you down further. Okay, and there is still weakness in the pound and strength in the dollar. A lot of these dollar pairs, pound dollar, New Zealand dollar, euro dollar, or dollar, they're all falling down because people are putting their money into the dollar. That is why the dollar index, or the Dixie, is increasing in value significantly. Okay, because people are putting their money in the dollars, they're not concerned with the pound. So, having said that, you can see that the way this is shaping up on the daily is really interesting as well, because what you've got is a push up here. That's really not very far. I mean, you noticed a minute ago I just mentioned how we've had a retracement of about 38.2%. It's not really significant enough, is it? I mean, you're hardly even pushing on to your earliest moving averages. You've come past your 20, but you don't get to your 40. So if you look at this daily candle as well, you can see it's really, really heavily pulling down. So I wouldn't take much weight in the lows here. Really wouldn't. I don't think they're going to last. And I think for that reason, you will get slightly lower. So I would just refer back to something like your weekly and just look at areas of price action where you've had a bounce before. As you can see, there's a lot of it here. And that would probably be a bit more ideal as an entry into the market if you are going to take it. So I wouldn't buy it just now, really. I would let it probably just come under this green candle here for new long entries. It wouldn't shock me if you get a bounce underneath this. Okay, something under there. I would make that entry very light, and I would consider really your main entries being around with this. Okay, because I think that is going to be a lot more valid. I think there is room to go from 121 to 117, albeit probably not very quickly. But just don't be fooled by your stock oscillator. Just remember it can just keep going into oversold, even though you have come down for a significant period of time. So above all, it's not a short. Yes, I do think it's going to go lower, but I'd far rather be an investor to the long side within a long-term market, especially after a considerable fall like this. Okay? It's fallen and fallen and fallen. You shouldn't be buying. You can only see two green candles within 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, going on 15 red candles. Okay, so it's not a long entry. You could teeter around of longs, but if you're an investor looking for longs for the long term, would be the case. If you were looking short, I would much prefer a pop up, okay, significantly. I would prefer to get much nearer this key moving average here. That is going to give you a really good short entry, in my opinion. So you can change your bias and look for a downside move. If it ends up being like this, okay, I wouldn't be shocked like that. It would only look short 126. Okay, I think that's far more valid for shorts. And I would make your entry mid-level. Okay, because 126, 145 area is quite ideal. Coincides very nice with those moving averages. I wouldn't be surprised if you do beat away at 100 MA or 40 MA or something like that. But ultimately, if you're looking for a longer term short with lowered risk, essentially because you're leaving room for a larger retracement, then it's probably going to be a bit more preferable. So you can see on your fib comes about 0.5. Again, like I said, quite ideal. So I'm just going to swap onto your pound CAD for a moment. I'm going to run over the pound CAD and the pound order as well, because I know lots of you will be interested in that. Many of you would have clicked this for the pound dollar, of course. These pairs are super important as well, especially your pound CAD at the moment. So again, much like your pound dollar, significant falls for a significant period of time. Okay, you get this sideways movement around the ending of the financial crisis, followed by this up move, and then Brexit comes around, like your other pairs, and you start to come down. Now, since you get to this point, okay, you have gone more or less sideways after that for a good few years. You can see that right here. If I just draw a box around it, you can see that with this area of price data, 2016 to 2022. So for 6 years, you could have range traded this, obviously short to the upside, Okay, you would have been able to do this for 6 years, like I've been saying with the pound New Zealand, it's the same. Um, and long to the downside. So you get the point, really. I don't need to draw all the arrows, but my point is that you could have done this for a significant period of time, and it was a very predictable price action market. You can see where you've fallen before, you can see where you've risen again. But suddenly, what happens is, okay, similarly to the pound dollar, you get this massive low, okay, and if you zoom out, it just comes underneath this, okay. You get investors say, you know what, that is an incredibly low value for the pound CAD. I'm going to get long because I know there's room to the upside, and of course, after a massive down move, you get a considerable up move away, which is why you had September the 20th, 2022 to September 23, basically a year of going up. You do have a slight retracement here with 200 candles, but for more or less a year, you've gone a significant way. Now, if you just look at what I've referred to here, and then you look at what you can see here, this is the ultimate tech zone. This is the ultimate technical entry zone. And this is why I teach people so much in regards to technical analysis. Because what happens is you come up to your significant moving averages. That's number one. You come up to your 100 and 200 MAs. So you know the price has retracted a very good way. You can see that by simply looking at a year's worth of green candles with two minor red ones, which didn't pull you down significantly. And the fact that your stochastic oscillator is already very high. Not only can those visual things tell you that, but also just from a knowledge of understanding moving averages, you know the closer you get to the higher moving averages, the more valid the price is going to be for a short. Because clearly, if you're going to come back to a range of 200 to 100 candles, then price has to be high for that period of time, which it was. Not only that, but you can see tons and tons and tons of rejection all along this price action choppy market channel. Like I was saying before, this is why I relevantly highlighted it, because that was going to be your reference point for your short entries. So you had your fall significantly, and what you got was a bounce over here. And again, that came in line with early levels of price action, which you can see there. Also coincides with what I labeled similarly to the upside, but you've got tons of rejection here. So it's really important to look at the past market, look at the history of the market, and understand that what has happened is going to greatly influence what happens afterwards. So if you just swap then to your weekly, well, what you can actually see is this bounce off your, again, significant 200 MA, okay, low stochastic oscillator, so clearly you've got a lowest price for that period, comes up here and it's rejected immediately. You can see a little bit of a stumbling pound CAD, and that's why that candle's not immensely big. Now, similarly to my bias on the pound dollar, therefore, thinking it will come slightly lower, I've got a similar approach with the CAD. And it's because there's significant price action underneath. Okay, you can see where you had that low, but underneath around here, you can see you've got candle wicks there, and then you've got this rejection you've seen so many times before. So that would be a very ideal place for me to plan to get long. Remember, if you are trading a downtrend, it's okay to be buying, okay, because the market is not always going to move in one way, right? And it may be that in future, the price does come in within this trend line up to here, but before it does, it comes down here, you see? That happens a lot. So that's why it's a good idea to be trading long within these downtrends, because when you're trading long on a monthly downtrend, you might be trading long on a 4-hour or daily uptrend, okay? You've got to understand how multi-time frame analysis works and how it's all one machine that comes together. You change your risk accordingly. So if you do get higher up here, it constitutes short in my opinion. I think you'll probably fall about there beforehand, but nonetheless, whether it comes at this point, it's short up top. So I'd look short 181 or 180, and I'd look long lower where I was saying it's nearer 158. So a big range of price, but FX markets inherently long ranging markets, and therefore being prepared for it is a good idea. If I just swap onto the pound AUD, I'll run over the pound AUD now. Again, similar story, although it looks slightly different from the 17s upwards. But once you get to the year 2000, the millennium, the market just starts to fall. Okay, some people would call this a head and shoulders. You call it what you want. I'm not particularly a pattern trader. Um, but what happens is you start to fall like this. You get your pop up, you pop down, you pop up, you pop down. Okay, and essentially skipping out a little bit, you've just continued that pound trajectory. Okay, so the pound is losing value, and you can see that. Now, what's really interesting with the pound AUD is this: if you look at the long term time frames, like your monthly, you can see you're reaching the top of your trend line to the downside. Okay. Of course, it depends how you draw them and what time period you pick. Mostly, I let computers do it for me. Parallel line would be in order along the other side. Nonetheless, what you do have is absolutely no surprise when you get full, because like your CAD, like your pound dollar, you've come up for a significant period of time, albeit with a couple of dips back to your key MAs, but still that's a really high price, hence the raise in your stochastic oscillator. And not only that, you're significantly far off from your key moving averages, which are all amalgamating in one spot. So I would say that it's likely this will continue based on the fact that you're downtrending long term. That's what's happened for years. So why would you change your bias now? Okay. On your daily, much like your pound dollar, your pound CAD, it's really weak. Okay. It's a very, very lightly slanted. Some would call it a bullish flag or things like that. Again, if you're a pattern trader, that's really your kind of thing. But if you drew parallel lines somewhat, you can see that it is flatly uptrending. So the reason why people talk about these patterns really is because there's not a lot of strength in this. Although it is uptrending very slightly on your daily, you've got to understand that although it's uptrending on the daily, it's downtrending on the monthly. Okay? So your bias, if you're a long-term trader, doesn't matter that it's coming up on your daily. You'd still be short overall long-term. And like your pound CAD and pound dollar, I can't see the strength in this, and I would expect the same, more or less. I would expect you would start to dribble down much nearer this key 200 MA. You'd probably see your stock oscillator drop as well. So looking for short entries, like I said, now it would probably be light. If you do get a significant push higher to something like this, it wouldn't overall at all shock me as a short entry. I'd still like it short there. And I wouldn't be surprised if that does happen. And like I said, if you want to refer to for your long-term entries, and I said about this a lot at the time, you can see that's where you've got your weekly support, okay, and it comes in line with all of this. The market repeats itself very, very well, but you've really got strong technical areas over here, okay, because you're at those key moving averages. Your stock oscillator will probably look something like this, and you've got all this rejection to go off. So that would be my long entry. I'm giving a good wide berth for these long entries simply because if you look at those higher time frames, you can see the market has dropped for a significant period of time. So we can all agree, probability wise, if the trend has gone on for 30 years, you'd probably want to be trading with it. You want to be swimming alongside it. That doesn't mean you can't trade it in the nearer term, which is why I label areas on your daily, your 4 hour and nearer when I do all kinds of videos like this. So that's a full overview of the pound dollar, pound CAD, pound AUD, both from a fundamental perspective and a long-term trending perspective. And really just make sure your risk management's right and make sure you've got the correct sizes. Of course, I teach people that fully in my academy in a massive video series, and also you get 3 months of mentoring as a bonus. So if you enjoyed this, guys, if it really helped you out, if you learned a lot of things you probably didn't know, okay, there's a lot of rubbish online, I know that. Don't forget to press the like button. Don't forget to comment underneath if you've got a question. Don't forget to share. Of course, you can follow me on TradingView, but above all, make sure your risk management is set within this long-term downtrending market. Understand that FX markets can swing for long periods of time, and get my free training underneath. It will help you with that a lot as well. I'll see you in the next video. See you there.